faster and more adaptive. You have to be much more willing to change. So when you do a successful walk forward, what you're proving is your strategy actually works. The process is robust. In other words, you're not just you. The alternative is to simply do an optimization on a big chunk of data and try to figure out whether or not there's robustness in that, which to me is actually pretty hard to do. Like we were talking about the other day, if you do an optimization and you have 1,000 different combinations of parameters, and every one of them is tradable, you don't need walk forward analysis. You've got something really great.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Bob Pardo, welcome to the show. Really good to have you here. Thanks for coming.
Yeah, it's good. My pleasure. It's good to be here.
Been looking forward to this. You know, this will work well, Bob, because the last pod we did was with Rob Carver, where we talked about futures trading strategies with end-of-day data, longer-term strategies. So now we can kind of plow into futures trading on intraday data, more so your specialty. So this is going to make for an insightful contrast to that.
Great.
And so, look, let's just start with your background, Bob, because, you know, you've got a lot of history. I don't know if that's me saying you're old.
Well, that's true also, you know. It beats the alternative of being dead, you know.
Well,
old is better than being dead, so.
This is right. So, but, you know, like going back to those early days, I mean, that's a really fascinating introduction to systematic trading, to trading in general, because, you know, you were there sort of in the heyday and you were developing software before anyone was doing this kind of stuff. So I'm keen to know just sort of how you got into the markets and into trading in the first place, and some of the highlights, people you met.
Well, you know, I worked on the floor I worked on the Merck floor when there was still the Merck and the Board of Trade. You know, now they're one and the same. But and I had I was close with a guy who was a floor trader who actually wound up investing in my first business. And you know, I just I really, you know, having seen guys on the floor and seeing how they the guys who were good at it really made a lot of money, and I thought, well, this is worth trying to figure out. But I don't know, to be honest with you. You know, I worked for a guy, and he was a bit of a psycho, and he actually one day he just fired his entire sales staff, and I was like his assistant, his right hand man, and he says, go see if there's anything worth in their desks and clean it out. And in the process of doing this, I came across Perry Kaufman's first book, the first edition of his book, and I certainly read through it, and I got the idea that you could actually, you know, you can come up with what we call then numbers. You know, my floor trading partner said, if you can come up with numbers I can give to my customers, that'll be a nice, because he was an order filler plus a trader as well. So I had a method of coming up with support and resistance numbers, which is actually very good, and actually based on something that was in Perry's book, but is no longer in his book, which is interesting. But it was a geometric construction that had a lot of Fibonacci stuff in it, and so I would produce these numbers, and then somehow, you know, I started researching the whole thing about, you know, what they used to call trading systems in those days. And in those days, trading systems were literally like people would write down some kind of formula or some kind of rule on paper, and I don't even think I'm not even sure they even hand tested it, but they would sell it for $3,000, which in those days that's worth about 15 grand now. So they would sell the stuff for $3,000, and there's a consumer newsletter called Club 3000, based upon the fact that people were selling things for $3,000 that might or might not work, and most of the time they didn't work. But it was so I started delving. I started seeing that people were doing this, and I thought, well, why don't I just started testing some of the ideas that were in Perry's book. I got my partner to buy an Apple II, which, I mean, and when we bought the Apple II, it had 48K of memory. Not and it had a floppy drive for storage, and I just started. I'd spend my mornings basically coding up. I had a shell written in BASIC that would load data and run a simulation on a strategy. So I would spend my time. That I usually could code up one strategy a day, test it, and see whether it worked or not. And of course, as you might imagine, most of them didn't really work. So
you started building your own software, didn't you?
Yeah. Oh, well, I built my own because software like that didn't exist. I don't even know when System Writer, which was what TradeStation was originally, I don't even know when it first came out, to be honest with you. It probably came out after after I came up with something. Somebody approached me with an idea, which I thought was actually a pretty good idea, and I took it and I coded it up, and I actually developed it quite a bit past what he had originally come to me with. Because what he really came to me with wasn't particularly that effective, but I was able to make it into something called Swing Trader, which was the first product which actually would allow somebody to actually build a customized strategy, and test it, and then trade it if they liked it.
That might be where people came up with the term swing trading.
Well, see, I think it probably is, but then people still don't want to acknowledge that I invented a walk forward analysis. So they're not going to want to acknowledge that I actually invented the terms. And the Swing Trader had a risk stop, which was, I think, the first time. I know it was like the first time I think I'd ever heard the term, but so yeah.
There was a couple of big names, wasn't there, too? In those early years, there was a couple of big traders around. I think you had some exposure to those guys. You were watching them, and it must have been inspiring you. Like, well, if they can do it, I can do it. And you're watching how much money people were making. So,
well, it was a lot easier back then than it is now. I mean, you just didn't have the markets just didn't have the number of players that it has now, and the amount of sophistication. Even though a lot of people don't know what they're doing, on the other hand, there are some people who really do know what they're doing, and the markets are way more efficient. That's one reason why, like, for example, Bitcoin is so profitable. It's really not that efficient yet. Even the Bitcoin futures. I mean, I know one of my customers was I had a number of guys who were floor traders, because a lot of the floor traders, as things changed, some of them wanted to kind of get off the floor and do something behind. They wanted to trade algorithmically. Well, that wasn't a term then. And he had one of the first prop trading firms. They're still around. It's not one of the big ones, but it's very profitable. But when they went to the prop trading firm, they started trading European futures. And I said, "Well, Jim, why?" He says, "Because they're inefficient." And that's one of the things that anybody on the floor they always talk about having the edge they have. They have to have some kind of edge. I remember I had another guy who was a S&P trader who had done very well, but he was customer of mine, and he said his edge stopped working. And this is the thing, people, some of these, like, floor traders, generally, mean, then that's not the case with all of them, but a lot of floor traders basically just really trade off order flow. They lean on the bid, and they get a feeling for where the stops are, and they gun for the stops, and they're not. In those days, it wasn't. It probably was a lot easier for those guys to make money than it is for the prop trading firms now.
When you speak about the changing markets, I mean, it makes me think of just how important it is to understand the markets to be a trader. So to have some feel for the practical reality of market dynamics, or market structure or microstructure, those kind of things are important for a newer trader, especially, to eventually learn as they're discovering what their edge is. But aren't there a few famous names that pop into your story, like people that you might have brushed shoulders with?
Before I actually started my own firm, I worked for Salomon Brothers. When I don't know if you know, they used to be the competitor of. They were like a Goldman Sachs kind of firm, but my job was to basically work for John Merriweather, who was the guy who became the head of long-term capital that actually almost bankrupted, almost broke the economy with their stubbornness. In terms of people, I don't think, I don't think that the people that I knew then were really that involved. Other than he was, he is a legend. I know Larry Williams and some of these guys, but that's Larry was always to this day. Larry is still he's very private about how his stuff really works. Well, Perry Kaufman was the biggest source of ideas for me at the outset, and one of the things as I got more and more into as we were building, because we built a program when we had Swing Trader, we had the first program we actually had was a program called Advanced Chartist, which was actually a very comprehensive charting tool. Before it was before Metastock, it was before TradeStation. It was a very nice charting program. It had a lot of features, and I wouldn't just put an indicator in there because somebody said it was a good one. All the stuff like that's when I came across median lines, and I'm not even quite sure where I came across it, but I came across median lines and found that they were remarkably good. So we had included. I was always interested in GAN and support and resistance and pivot points, so we put a lot of that stuff into Chartist. My education as a trader or technical analyst came from really researching ideas we're going to put into Advanced Trader, which have ultimately Advanced Trader had a scripting language, so we called it scripting, and it was you could actually that was what you could write a system with it. That was so Advanced Chartist. Actually, Advanced Trader actually was a DOS-based version. It was drop-down menus, but it was DOS-based, and it was like TradeStation before TradeStation existed. We didn't have it working with real-time data. I worked on daily data in those days, and anything you could get into it through ASCII, it would work with. But so to a large extent, my education came about with actually seeing whether these things we put into the program actually had any value.
You're one of the very early adopters of using systems to actually validate some of these rules that were coming along, and then beginning the back testing process. So I just want to give the listeners a bit of an overview of where I want to go now, I guess. So I think we're going to end up doing 2 shows. So we'll see how we go, because we've got a lot to get through. So in the first show, we'll just cover a bit of a background and talk about how you trade and so on. But the reason why it might drag out is because, as we've been discussing, I've got a lot of questions around walk forward analysis and this kind of thing. So if we push it out, we'll push into a second show.
Sure. Makes sense.
That's the plan. So for today, Bob, I thought let's just get into how you actually trade today. So there's been a lot of ebbs and flows over the years. So, Bob, I noticed that the gold system that your clients trade would have done very well today. But just across the spectrum of those, there's a lot of strategies and systems that are available on your website, for example, that presumably your clients are using, deployed in various ways. We could get into that. But what's the sort of philosophy behind these trading strategies that you build today? What kind of strategies are you trading? What kind of markets? How diversified? What time frame? Just give me the high level view of.
Well, I basically I've been an advocate for years of system diversification, not just market diversification. In addition to which, although we've yet to really incorporate it, we're exploring using different time frames within the same portfolio. Basically, I've had these things, the strategies that were based upon XT99, the things that are based on Ranger, which are based on different range breakout on steroids, shall we say. And what we did, and also the things we use with cross and LDR, which are moving average based. But I guess in truth, what the big picture is, I want more strategies rather than less. So when we build something with Ranger, for example, we come up with 128 different variations. And among those variations, usually there's anywhere from a quarter to a half, if not sometimes more, that are actually tradable. And the reason it's when I look at, I guess we should maybe kind of digress in a way, because I don't think of, when we build strategies with Ranger and with Cross and with XT99 and so forth, I don't think of it so much as optimization as much as I do as of exploration. It's like when Edison invented the light bulb, he went through 2,000 combinations before he got one that actually worked. We don't go through 2,000 combinations to find one that works, but the idea is similar. I mean, I think, people, I know Murray Ruggiero used to always say we would disagree because he didn't really like the idea of having different parameters for different markets. And I said, we never really, he didn't think what I was doing was wrong, but he just didn't like it himself. But what I've seen, for example, is you can actually take, when people usually have a strategy, for example, that uses like one set of parameters, or uses one strategy and one set of parameters, and they test it on a portfolio. What you're typically going to see is some markets will do great, and some markets will not do so great, and some will just do probably out and out poor. And that's the difference with doing walk forward analysis. You don't have to. I've never really believed I never really believed it makes sense to not use the best possible variation of a strategy just because you want to have the same parameters for every market.
For every market. All right. You're going to cover the whole podcast in one sentence, so I'm going to bring you back.
All right.
So you primarily trade futures. Do you trade any stocks?
No, not now, but we run the stuff with stocks, and it works very nicely. Mm-hmm. So that's on the horizon.
Nice. And I know in the past you traded a lot of end of day, longer term systems. All of your systems today intraday, or do you still value end of day? Do you think there's merit in end of day, or do you prefer intraday, and why is that?
Well, I prefer intraday. I haven't looked at daily for a long time. And the primary reason why I really don't look at daily is because as you go faster and faster and faster, what you get are more opportunities. And so, these I don't think there's anything wrong with daily. We're trading on a daily time frame, and a lot of people like it because they don't have to really watch the markets. They don't have to really, it's much less labor intensive than the intraday stuff. And I understand that. And a lot of people who are not professional traders don't really have the time. So there's nothing wrong with it. But I think you have to, I think it's let's see, I wonder if we actually built, I think when I first built stuff with Ranger, I may have built it on daily data. I don't remember. But the thing is, what actually, when we actually built, originally XT99 was built on daily data, and it ran on daily data, and it made a lot of money on daily data. So obviously, I'd be a fool to say it doesn't work, because obviously it did work. It worked really, really well. We averaged almost 20% a year for 12 years. So, but
can we just digress into that story just momentarily,
Sure.
Bob? Because that was work that you did for Dunn Capital. Is that correct?
Yes.
Do you want to tell us a little bit about that?
Sure. Well, it's I'll try to give you the middle version of it, because it's a fairly long story.
Yeah.
XT99 basically was based upon a strategy I built with a program we called Blast back in 1993. So it was built way back then. And when people say strategies, like when one of our competitors likes to maintain that a strategy only has about a year to a year and a half shelf life, and I've always thought that was just complete bullshit, because I don't think there's any empirical basis to make a statement like that. Maybe his stuff doesn't last that long, but that's not anyway. So I don't think there's any sense to that at all. But then when we wanted to revamp XT99, I didn't want the drawdowns. But anyway, what actually happened was we built it in '93, and I was actually part of a project for another big firm called Daiwa Securities. We were actually building a multi-strategy platform with which to manage money, and what we constructed was actually way better than specification, and they chose not to do anything with it, only because the crash in Japan basically put them into a situation where all they ever wanted to do was make money from brokerage. And my cousin, the person I worked for at Daiwa, was an American who was a customer of mine before I worked at Daiwa of America. And so he liked this idea, but he didn't have any choice in the matter. So he said, "Here, they're all yours. You can have them all." So I was looking for something new to do with these things. And my wife simply said, "Look, you got all this stuff. Stop making new stuff and use what you got." So I started making phone calls, and I wound up talking to a guy at Dunn named Pierre Toulier, who unfortunately passed away some years ago, at a rather young age. But he was a real can-do guy, and he really liked what XT. He really liked what I showed him, and it was faster than the stuff they had. So at that time, they were embracing what they called their joint venture partners. And he said, "Sure, let's do this." So they basically took the strategy, and they didn't really modify it in any way, shape, or form. But with one exception, they, instead of actually following the same walk forward cycle that I had developed it with, they went to a longer time frame. So that was, and then they had a method of picking strategies and parameters that's a little bit more. It's a little different than what I do now, but it was a decent method, although I didn't agree with them entirely in all cases. They handled all the executions, and they basically put XT99 running in a bunch of their funds.
Yeah, interesting. So it effectively ran for quite a few years, right?
Yeah, it ran from 99 to we ended our relationship around the end of 11, and we had a customer who actually stayed with it, and he was actually doing well, except he had his account at Man, and he got when Man collapsed, he really lost a lot of money, and he said he was never going to go near futures ever again. And so he ended it, and then we ended XT99. And actually, I didn't have any good reason to not do anything new with it. But I also, I don't know. I've always been a little bit. I was a little more headstrong in those days than I am now. But a couple of years later, we got the idea to do something a little bit different, and I found a way to actually make a number of different strategies out of. I found a way. I discovered the process that I use now to actually take a basic strategy and permutate it into 3 or 4 different kinds of basically uncorrelated forms. And we did this with XT99, the original version, and came up with really about 45 different strategies that some of which they were families. There were 3 families, one based upon the original XT99 concept, one based upon an evolution of the XT99 concept, and one based on patterns that were the patterns that we found in momentum. But I wanted to build it on 60-minute bars because I didn't want to have because we had a fairly long lasting drawdown with XT99. I associated the length of the drawdown with the trading pace, which is logical, of course. So that's why I moved to the 60 minutes.
Yeah. Okay. That nicely brings us back to where we diverged. So I mean, on that, as you were saying, some people shy away from it because of the the complexity, say. But so let's just drill into that for a second. I mean, how technically difficult is it to, set strategies up and let them run on a VPS and with monitoring, no doubt we can do that quite safely these days. So, is it that complicated? What's the kind of technology that's required, a trade station, a MetaTrader, and
it depends on the software. When we were doing what we called Pardo Renaissance, that was actually what we actually did do was we actually had TradeStation. I had the programmer have TradeStation actually produce the signals and export the signals into a report that the clearing firm we're going to execute through, would just upload directly into CQG. And then it went from there. So it kind of depends. Setting up TradeStation just to generate signals is pretty trivial. TradeStation is a little brittle. So putting it on a server is a good idea only because you're not going to have anything else running on the server. That's the way you should do it. And it's not that difficult. But one of my customers, for example, he kind of goes back and forth between using TradeStation and NinjaTrader because TradeStation is not that stable, and NinjaTrader he found was more stable. Another one of my customers uses MetaTrader because he finds it too is more stable. So
multi-charts would be another one, isn't it, that uses easy language?
Yeah, multi-charts, right? Yeah, and so that's not that difficult. But you do have to. Most people who do this make a point of reconciling their trades every day, and if TradeStation crashes when it's during the trading day, you got to go through a kind of an involved process to make sure everything's actually. If you miss a trade or whatever, you got to deal with that. So
with intraday trading strategies, how much data do you tend to use, Bob? So do you use like all the possible available data, or are you happy with, a 10-year data set? Because if you go back too far, the data starts to become less relevant, or it's not that way at all. Like, how much data do you like to use?
Generally, when I'm doing, I generally use about 10 to 12 years of hourly bars, and it's not so much. Ultimately, it's because of the fact that whenever you do any optimization, the optimization is married to the data that on which you created it. So if you and for example, if somebody wants to build a strategy on the stock market, and you look at the, let's see, what did it do since, I'm looking at a chart over here, since 2022. It's not been straight up, but it's been, there's a 1, 2, 3. It's really been pretty much in 3 years. There have been, it's pretty much all been up with 3 corrections in it. So, and one of the things, so you kind of, the data whatever data you pick is going to determine, even if you do a walk forward analysis, whatever data you pick is going to, it's going to, whatever's in it is what the market's going to be tuned to. So if you're, you have to be, that's one reason why looking at 10 or 12 years, you're bound to have more, you're going to have more variation. One of the things, that we found with Ranger is the newer models. The older models just didn't do very well on the short side. The new ones do much better. What we've been doing now, for example, with the stuff we're working with, we've looked back at about 10 to 12 years, but then I also look at a 4-year. I look at a 5-year look back, because sometimes they're in alignment, sometimes they're not. But you have to lean towards what's happening now. So the data you use, you have to always be aware of the fact that the data you use imparts a certain bias. If you've had this, you're going to pretty much be okay. But if you've had this, you're going to have a bullish bias. So you have to be mindful of that. So I think more, especially when it comes to like daily, I wouldn't look at anything in daily with less than probably 20 years now, to be honest with you. And part of it is you get more trades. You get with faster data, you get more trades. So you have more, because one of the things I found was we used to, the walk forwards, with walk forward analysis, you can actually have one individual walk forward, and it can be great. But one individual walk forward is not really a good predictor of future performance. It's a good measure. It's a good start. But one of the reasons why we went towards faster walk forwards was because the more walk forwards you have, the more confidence you have in the results.
I want to get into that, and I want to give people a background, like an introduction to walk forward. So let's just push through, this introduction that's taking time. But all right, so you're trading futures contracts. How many futures contracts does someone need to trade to have a diversified portfolio? So you said that you prefer system diversification over market diversification.
It's in addition to.
In addition to, would you, with talking to someone like Rob Carver or the classic trend followers that we've had on the show in the past, trading end of day data, they're really trying to access as many futures markets as they possibly can. Is a handful enough of markets with a number of strategies sufficient for you? Like, how far do you need to push that diversification? Are you looking specifically for non-correlated instruments? And that just ties into, the account size required to trade this. And especially if you're a smaller trader, can you trade the micro lots? Can you get away with a fairly diversified portfolio on a relatively small account size?
Well, it's more difficult, obviously, because it's a matter of capital. What you have to do, I think, the way somebody, if you want to start building with a small account, I think that the probably the smartest thing you really can do is go to a very, very short time frame, and not so much day trade in terms of having like one trade a day or something like that, but have perhaps multiple trades within the course of the day that are smaller, because you can have smaller risk. with your individual stops.
Is it all equal to you? Sorry to interrupt, but is it all equal to you? Do you think like a 5-minute chart is equivalent to a 60-minute chart is equivalent to a daily chart, or they fundamentally change as you increase the noise and the percentage of commissions at the smaller timeframes, for example? Do they end up requiring different attention and different strategy types even?
Well, I don't know about different strategy types, because I think we've worked with our stuff on hourly bars and daily bars and 5-minute bars and 10-minute bars. What you do have to change things a little bit, because I mean, the parameter ranges, for example, in 60-minute bars probably aren't going to be that great on 5-minute bars, and you have to. One of the things, I believe I've mentioned this last time we talked about this. The significance of a monthly high is more. A monthly high all by itself is much more important than a weekly high, more important than a daily high, more important than a 60-minute high, more important than a 5-minute high. And what you kind of find is that the highs, breakouts in Ranger, we have a lot of you can put filters on the breakout, and we did that because there is. It's a function of it's a way of filtering out noise. But if you look at a 5-minute chart versus a 60-minute chart, you'll see that the higher breakouts of highs don't mean so much on a 5-minute bars as they do on 60-minute bars. So you have to kind of factor in the fact that it is get a little bit. It's not. I'm not even so sure it's noisier as much as it is. It's just kind of like. You can say maybe it's maybe 5-minute bars are a little looser than 60-minute bars versus daily bars. So you have to deal with that. I don't think the strategies you have to change. I don't really think that I don't even think there's a particular strategy that would actually do better or worse, at least the ones that I have in different time frames. And the part of the thing is with the micro contracts are great, except there's not a lot of liquidity. I mean, we kind of stuck with Cross. We work with a brokerage firm here, and they have a lot of small accounts, and they nowadays they're not even so small anymore with micros. But the only real liquid micros are the stock indices, gold, crude, and what else? And interestingly enough, the micro Bitcoin has more liquidity than the Bitcoin futures contract does. So it's not an accident that we chose those for Cross, because that's where the liquidity is.
Coming back to the diversification piece, then how many futures contracts do you like to have in your watch list that you could potentially be working and building strategies on? And when you build a portfolio, if someone wants that, the most robust, they want a robust portfolio of markets. How many futures contracts do you think is a good average number to be deploying on?
I just tell you what we did. So when we traded XC99, we traded about 50 different futures contracts. Bill Dunn, who used to own Bill, he's the founder and the former owner of Dunn Capital. He sold it to one of his people since then. But he wanted. They always said he never wanted to miss an opportunity. So we're in every market, and that isn't always great. But I think you should probably trade as many markets as you can afford to. But I think I've always thought that if you wanted to have like a nice little mini portfolio, a nice little mini portfolio would be like gold or silver, a stock index, something like soybeans, crude, and maybe and I guess Bitcoin in there. That would be. Although I don't know, it's really a currency per se. It trades way better than most of the other currencies. But if you want to have a real currency, something like euro, euro is probably the best trading currency. So that's a nice little mini portfolio. Depending on finances, the E-mini is great, but the NASDAQ trades, it's much more volatile. So if you had to pick one, if all things were equal, I would trade the NASDAQ over the E-mini. But yes, you want to have that in there, sure.
Are there any markets that you've, just come to despise and you just never bother with? Are there particular markets that are just
Euro
not
dollar.
worth it?
Euro
Yeah.
dollar. I mean, the interest rates have just been one way for so long. They're, I've always thought it was important to have one in there, but none of the stuff our models just don't work. They just don't. It's not worth it. There's just not enough motion in there to make it worthwhile. But so I mean, ultimately, but things change. So you really, I think it's probably ideally what you really want to do is have. Ideally, if you were trading one strategy, and just expand this, if you're trading more than one, if you're trading one strategy, you'd want to be looking at virtually all the liquid futures, which would be about, when we did Renaissance, we did about 25 futures. I didn't want, when Dunn did it, actually I was very, very heavy in bonds, because there are bonds everywhere in the world, and we traded in all the global markets. And then the stock indices are very, very, very. There's a stock index in most of the advanced economies. We had an excess concentration in bonds and stock indices. So I think you really want to keep it in balance. Ultimately, when we're trading XT99, people talk about lack of correlation in stocks, because there's nothing but correlation in stocks. But people think there's not a lot of correlation in the futures markets. Well, I'd say it kind of depends, because when we had our best year in XT99, made 142%. Everything was correlated to the stock market.
Yeah. So, no, it's true.
And correlations change over time, so you have to be aware of that. If you had like that mini portfolio we talked about, where you have an ag, you have a metal, you have a stock index, you have a currency, and if you can get a rate in there, that'd be nice too. But so that's ultimately, all interest rate futures will go in the same direction. They're not going to not go in the same direction. They'll go there at a different rate and different pace and so forth. All the stock indices are going to pretty much go in the same direction. Same thing. There's some differences, but for the most part, they're all going to go in the same direction. There's more. I mean, when I worked at the Merck, cattle was king. That was there before the S&P. Cattle was the big market at the Mercantile Exchange, and the meats. We haven't looked at meat. I mean, I don't look at meats for philosophical reasons, but they don't trade. They really don't trade well technically. So I wouldn't say I despise them, but I wouldn't waste my time with them. Let's put it that way.
Okay, so just another question on the strategy style, I guess, that you favor. I mean, do you call yourself a trend follower or a breakout trader, or are you equally happy to trade, mean reversion? So do you trade a mix of styles, merge them together? Are you specifically trying to merge non-correlated strategies, or do you stick with a particular theme?
No, I don't have a bias. My bias is for things that are robust and things that work. That's my bias. So, but I don't care how they function. I'm familiar with a lot of this stuff. My favorite kind of strategy really is one based on patterns, but that's actually way more difficult than we have things that do it. But it's a long story, but they're more difficult than building things that work with patterns. It's a lot more difficult than doing any other kind of strategy. But those are my favorite kind. So but we pointedly, we don't have this so much in cross because it doesn't really have this capability the same way a Ranger does. But in Ranger, we always look at with counter, which is kind of like mean reverting, and neutral. And they're
trend,
not
counter trend,
and
no
neutral
trend.
and they're not correlated. They're pointedly not correlated. And we do that because I personally feel it's to have a, like, for example, the Ranger Alpha 22 stuff for NASDAQ. There's a counter, neutral, and width, and they're not correlated, and you can see it clearly because the drawdown is always about the drawdown of a trio usually is about half of the drawdown of one strategy multiplied by 3.
So this is what you call your trio, isn't it?
Yeah.
And when you're building, are you pretty much focused always on long and short, or do you focus on long, and if that works, then you can't find a short version that works, you don't bother, or you're always trying to sort of balance deploying long and short models?
Well, the ones we have now are all long short. We don't have a bias. But that doesn't mean, for example, that's more a matter of time and computing research power. I personally have always believed that we would do better. We could do better with a long version and a short version than we could with a long and a short version.
And do they have to necessarily be symmetrical, the rules for long and short, like inverse, or not?
So they almost won't be. You're not going to find, no bear market behaves the same way as any bull market that I've been able to see. So no, they would not be symmetrical. That's the whole point of them. I don't think they could be symmetrical, and I don't think they should be symmetrical. One reason why it's so hard to build short strategies in the stock market is because the moves in the stock market are very short and very intense on the downside. On the upside, you'll see this little, it's almost like you want to go to sleep. But the crashes are intense and quick. And that's one reason why you probably couldn't have the same kind of parameters. Yeah. And I don't think that's necessarily the case with all markets, but I also don't think that the parameters will be symmetrical in a long and a short strategy.
So maybe this is a good time now to just build up a bit what you touched on before, which is another aspect of this is whether you think that the same strategy should apply on all markets, and if it doesn't apply on all markets, then it's not robust. Versus so this is the argument you had with Murray Ruggiero, who unfortunately also passed away younger than he should have recently.
Very, very much so.
Had a big influence on the market, on TradeStation, all of that kind of stuff. So, yeah, what's your philosophy on that?
I don't think a strategy has to work in every market. I would say that, if you, I think, it kind of depends. If you understand, let's say your strategy was really very, very idiosyncratically defined by some unusual kind of phenomena in a market, well, that it would only work in that market and other markets and no other markets is not a surprise. And I don't think there's anything wrong with that, as long as it's robust. But I think, and like, for example, with Ranger, it works. Ranger and Cross will work in futures, they work in stocks, they work in crypto, they work in currencies, but they don't work equally well in every one of them, because you just don't have you don't have the motion in all markets. So I remember when back in the 80s, on the Merck floor, the T-bill futures used to be as volatile and as liquid and as popular as T-bond futures. The ranges in T-bills when prime hit 15 and 16 in the U.S. were like 30, 40, 50 basis points. The trading was fantastic. And my partner, the guy who invested in my business, was a T-bill guy. And the market ran up what I call the bull market, the mother of all bull markets in those days. The market ran 1,000 basis points. Then it went like this. It barely had a correction through the whole move, and then it went flatline. And my partner was really getting killed there was no volume, and he couldn't make any money trading. I said, you got to move. You got to go someplace else, Norman. He said, well, what am I going to do? I said, he said, go to the S&P pit. And he said, I can't do that. I can't do that. So he basically, I lost touch with him. But ultimately, when markets can drop, things can happen to a market, make it totally untradeable. So you have to be aware of ultimately, if all you ever did was make a point of finding out which 5 markets were trading the very, very best and traded those, you do a whole lot better than trading 25 markets if 15 of them were dogs. And that goes for stocks or anything. It's just you really want to go where the action is, and if you only trade what really is active, you'll do far, far better than you will if you basically just tried to trade a portfolio because trading a portfolio is good. Make sense?
It does, and I think it's a really interesting point, especially if you could systematize that process of constantly scanning and reallocating into your actively traded portfolio.
No, that's yeah. Well, we do have that, but
right. Well, I was going to ask you, how your strategies have evolved over the years too. So, having been at it for so long, I think it's a great question for you in particular. You've got more experience than most in the systematic trading over that time period. So, what are the philosophical meanderings there? Have strategies and markets changed substantially or not because you've found, robust, quote unquote, eternal truths? What's the approach there? So, yeah, how much of your strategies changed over time, or your approach to what has changed, if anything?
Well, it's interesting because, like I said, we actually the XT99 was based on the volatility breakout concept. We built it in 1993. It was great. We ran a version of it, the XT99, and with Dunn made millions and millions of dollars for customers. So it was great. It still works. I actually just recently I'm going to revive it, and we actually ran it on a bunch of we have the four different variations of it that are uncorrelated, and they all didn't work equally well, but the whole thing did work well. Moving averages are as old as the hills when it comes to strategies. The range breakouts as old as the hills. They still work, but they don't work with. Like I remember, I had a conversation with one of the guys who was one of the turtles who became a popularizer of the turtle trading strategy some years ago. He maintained that you can only use the same set of parameters on all the markets you wanted to trade. I said, well, God bless you if you want to do that, but I don't. I think that's really a waste. So I think the biggest thing that probably has changed is that I realize I think the markets have changed in one big respect, and that because of electronic trading, there are many more players, and they are way more efficient than they used to be. But they still run. People still make money trading. So you're just the markets have changed, but I don't know.
Has your approach to strategy design changed? You've obviously gone through iterations of and we'll get into walk forward analysis next time, but you've obviously progressed that process.
Sure. I think the whole big difference is you have to be faster and more adaptive. You have to be much more willing to change. So when we did Renaissance, for example, one of the things I found was Renaissance had like 45 strategies and different strategies. And the most mature sector in Renaissance were the stock index strategies. And we would have we had 40 strategies running, for example, in the E-mini. I think we did the NASDAQ and the Dow also, but we had a lot of strategies in all of those. And so one of the things I realized is that there's 40 of them, but we couldn't trade all of them because it was even even in a big account, you couldn't trade all of those. Well, it had to be, you couldn't have a really big account, but in the account sizes we're looking at, you couldn't really trade them all. So we would boil it down to 10. And that's when I realized that it makes sense. It makes sense to always stay with the strategies that are doing the best and that are doing the best overall. They're doing the best overall, and then doing the best currently. And that's really some of the people that I know who are actually who are trading in a much more sophisticated way, are really trading in a very adaptive way. So you have to, I looked. You really have to. So I guess the biggest change really would be that I went faster with the time frame, faster with the walk forwards, and I'm much more flexible about sticking with a strategy. I know if we had done XT99 the way I'm doing it now, even with the one strategy, it would have made way more money than it did. So we just, because I know people when. So I think, and the other thing that probably has changed, and I haven't really implemented this so much as of yet, but I've become much more aware of the fact you can really manage risk in a very aggressive way, and I think that's probably, and in Renaissance we had built into it stops that would throw a strategy out if it went past a certain point. We had rebalancing based upon what was going on with the account size and with the volatility of the markets. So I think you have to be really flexible and really adaptive, and just like people who want to say they want to be right more often than they want to be wrong, but they'd rather be right and make less money than be wrong more often and make more money. I think you have to be willing to say this strategy. I've got 5 strategies here. This one's not doing so hot. This one's doing great, and respond accordingly. Does that make sense to you?
It does. It does. Are there particular when you talk about great and not so great? Are there particular performance metrics that you like to look at when you're assessing strategies or building strategies? Above and beyond just the raw performance. Are there particular sort of risk-related metrics that you favor?
Since we're stuck with TradeStation, we don't have a lot of choice. But I do know from our other stuff back in the day that, and I'm looking at this more and more now since we're working with some other vendors. The metric makes a difference, but it's the performance metric. Comparing, for example, like net P&L or P&L divided by drawdown or something, these things aren't so. I don't think those metrics are really as important as understanding the dynamic of the equity curve. Ultimately, what it comes down to when you're doing a walk forward, you would want the same thing in every individual walk forward that you would want in an equity curve that you're going to trade with. And a strategy.
Do you always use stops in your?
I do now because I do now. Yeah, I do now. Yeah, but not small ones. One of the things, I remember when I first started working with risk stops, I didn't like risk stops because I really found they were using smaller risk stops with XT99 really kill performance. So I talked to the only person that I knew who I actually thought I could learn something. I talked to the only person I knew who actually knew more about this than I did, and that was Perry Kaufman. And he said, "I'm not surprised that risk stops are hurting, not helping." He said, he's not a big fan of them. So I do use risk stops, but not small ones. It's a lot easier said than done. Coming up with people talk about trailing the stop and so forth. It's a lot harder to make that really work. And one of the things I think ultimately is, when it's when I look at the stuff, our stuff, and for example, I look to see whether or not I'm looking to see how efficient the trades are. And so I think ultimately, if you really wanted to figure out the best way to evaluate a strategy, you would really look at how efficient the trades are. That'd be one of the best metrics you could possibly do.
What do you mean how efficient the trades are?
I bought it, never won against me by one tick. I got out, it never won against me one tick getting out. That's
Right.
100% efficient.
Yeah. Well, what about targets? So in my thinking, if you're trend following, when you're building strategies erring on the side of trend following versus, say, mean reversion, you don't necessarily want targets. You want to be able to capture the really big outliers when they occur. There are other strategies where you may want to have targets, but what's your thinking there? Do you have strategies that are uncapped to upside?
Well, let's put it this way. I'm not opposed to the idea if you can manage risk some other way, but all of the current Ranger strategies, you have risk and targets. Now, for example, in the NASDAQ, the target, it may sound like it's way too big. The target, like some of the strategies in NASDAQ's portfolio, some have an $8,000 target, some have a $16,000 target. Ultimately, you really the issue with trend following and targets are you can deal with it. You can deal with the concern people have using a target in a trend following move is that you're gonna get into you're gonna buy it, you're gonna get out, and then you're gonna watch it pile up more money. That's the big concern. So the way you deal with that, of course, is simply to have some method of re-entering. So, and that's why, like in the current markets, we've kind of shifted. The range of strategies had a poor February, and I really don't like to see any losing month, but it had a losing month. And I looked at it and I thought, what the? So I probably was overkill, but I did a way deeper dive into what the whole thing was about than I probably was necessary, but I did anyway. And I found that ironically that the ones with the bigger target was still doing better overall. But the ones with the smaller target was doing much better in these kinds of, shall we say, interesting times. So there's nothing wrong, for example, with having a trend following strategy that you could have 3 variations of it with different targets, for example.
Yeah, that's what I'm hearing. That you could have targets, but you're then looking at the philosophy of how do I capture those really big outlier moves, and you're tackling that another way by overlaying more strategies, making sure you can re-enter and that kind of thing. So you're assessing that from a different level than the individual strategy build, more from a portfolio level, just to make sure you can capture.
That's the one thing. You see, you're trading more daily than when you're looking at 60-minute bars. There's a whole lot of stuff going on in the course of a day, and a whole lot of stuff going on that you don't see in the daily stuff. So that's part of the. I mean, I know that when we built a highly customized version of Advanced Trader that ran for Goldman Sachs, and the person I worked with there really died at a very young age, ending that project. But he was a really intelligent, really a smart guy, and he was very proud to say that they settled every single day, their trades every single day. And I thought, well, what's so special about that? But what it kind of really boils, I think people who trade shorter term don't really get so much caught up. You don't get so much caught up in missing the big move, because there's going to be a lot of opportunities to get on board in the course, because there's always going to be corrections. And look at this move, for example, on monthly bars. If you bought it back in October of 22 and held on to it, you would have made buckets full of money, but you have some heat in the meantime. So the question really gets to be how much heat do you want to take? Like when I'm looking at to improve our strategies, I've realized that the only way to really improve it is not so much to improve the strategy as much as it is to really improve the of a much more sophisticated kind of risk management.
Okay.
And that's one thing you could look at. You could even look at, for example, for your stuff, you could look at the weekly. You could look at the trend from the daily data, but you could be looking at something on 60-minute bars and seeing, in the perfect world, if you're trading daily bars, and then you've been long, you've got a big profit in there, and all of a sudden the market takes a dump, and you haven't had a signal to get out. Well, you can be looking at 60-minute bars and a strategy on the 60-minute bars, and you can be getting out. You could be trading around the position on the 60-minute bars and never really lose your position, or at least keep your position intact, if that makes sense.
Yeah. All right. Well, Bob, like as we start to wrap up, I think, but what we want to do is move into, like, lay the foundation for the next discussion that we have, where we just deep dive
Sure.
a bit more the specifics of walk forward analysis. So, do you want to just lead us into that? And the big picture, when I think of walk forward analysis, what I like the most is it's just a systematizing of the process. Myself and my colleague have been talking a lot about this lately, where, as traders that have more and more systems and more data and more research projects, the more that we can just systemize the process of, strategy discovery, strategy robustness testing, and then, ideally something that helps us manage the strategy once it's deployed live. I'm a big fan of having systematic processes around systematic trading. It kind of
Sure.
completes the circle. So that's a kind of a philosophical statement, but walk forward analysis is really that to me. It's a really systematic way of approaching this whole process of building algorithmic strategies. And because one of the big issues that we're all tackling is the amount of data that we have, and then the tendency for humans to overfit and create unrealistic strategies on that data. So, to have a process in place that, is probably one of the most well-known and powerful ways to tackle that overfitting problem, is just huge. So, we'll chat again and really delve into it, but really basic, like, explain to people who don't know what walk forward analysis is, explain to us what it is.
Okay. Well, the big picture is, and the reason why we do it is because walk forward analysis tells us the strategy is robust, and the performance of a walk forward analysis is the performance of the strategy measured entirely on out of sample data. So it's not, it's almost the complete opposite of an optimization. So what a walk forward analysis really is a set of individual walk forwards, move through time. So you start, if you're going to look at a walk forward that's going to be like 3 years by 6 months, so you're going to optimize on 3 years and trade it for 6 months. What you do is if you do it the right way, if you want to look at 10 years of data, you actually start with 13 years of data, and you do your optimization window for 3 years from, like, say 7 or 8 to 10, and then you get your parameters, and then you trade it for 6 months. Then you record the results of the out of we always did it. We save the results of the in sample as well, but we save the results of the out of sample. And then you take, if you optimize on, say, 8 to 10 and traded it from 10-1 through 10-6, you then move the whole window forward 6 months and trade it from June of 2008 through June of 2010, and then you get the parameters and trade it for 6 months, and you're done. And you move the whole window forward again. So what you really have is you have one walk forward, moved forward through the entire set of your data, and the walk forward analysis is actually the performance of the sum total of all of the out of sample windows.
So you have this in-sample period followed by an out-of-sample period. You optimize on that, and you take those parameters into an adjusted forward period, which includes the entire previous period. Optimize your strategy on that, and then see how it runs on an out-of-sample period for the next year, say, after that. And so we're building an entire backtest on an out-of-sample adjusted period, but we've implemented a process for this. Let's say it's 2 years, we do a backtest and 1 year out-of-sample. We've now got an entire process for what we do at the end of every year to update and adjust the strategy parameters. So the first question for someone like me who doesn't really come from that background is, is the assumption there, and it might not be, but is the assumption there that the more recent data is the most relevant data to be using going forward? Or is there more to it than that? Is there a subtle shift? Because by building that process over that amount of time, what we've also proven is that we've got a process that can, take us through various time periods. So it's really the process that we've tested and checked off, so that yes, we're re-optimizing on recent data, but it's how we optimize and the parameters that we end up with that make sure we end up with a robust strategy that'll work forward no matter what the future brings. So I'm asking about optimizing on recent, just to keep it simple to start with. If we're looking at a recent window of data, is that necessarily the best predictor of future returns?
Well, I think it goes without saying that the most recent performance is the best predictor of the performance to follow it. That I would agree with, and I actually even talked about that in my book, which people have. I can't believe it's one of the best things in the book, and people have completely ignored it. It kills me. But the thing is, you have to like I said we were talking the other day, when I was using Advanced Trader to do this kind of stuff, I would test on 5 2-year chunks to see whether or not it actually was profitable and for the last 10 years. And I wanted to see what it was like in different periods. I think that when you do a successful walk forward, what you're proving is your strategy actually works. The process is robust. In other words, you're not just the alternative is to simply do an optimization on a big chunk of data, and try to figure out whether or not there's robustness in there, which to me is actually pretty hard to do. Like we were talking about the other day, if you do an optimization and you have 1,000 different combinations of parameters, and every one of them is tradable, you don't need walk forward analysis. You've got something really great. But I honestly don't. I think one of the things you want to know is whether it will work in different kinds of periods of volatility and trend, and how well it works in times like that.
Well, perfect. Let me ask the second question there, because that's highly related. So what I wouldn't want to do is, quote unquote, forget the distant past necessarily, in the sense of, an 87 stock market crash, corrections that we've had in whether it's 2011, 18, whatever, vol periods, various catastrophes, let's say. They're really important in my thinking, because they're things that, can sort of disappear from recent memory, could for a newer trader building a strategy, let's say, that's never been through that, they may not plan for that, and therefore build a strategy without that in mind. And lo and behold, the rare event that may not be so rare comes along, and wipes the trader out. So I want to make sure that I've considered what could happen to my portfolio in a 1987 stock market crash, for example.
Sure.
And that also pertains to the kind of strategy that it is. Like for a particular kind of strategy, for a mean reversion strategy in equities, I'm very concerned about those, those huge events where all equities move together, they go down and keep going down. For trend following strategies, I'm interested in other problems that could arise. So, how would you answer the question, I guess, around being mindful when we're building a strategy of how it's going to, stress test under these extreme conditions that have happened in the past, if we're not necessarily, how are we factoring that into this process?
That's what the walk forward does. It'll show you what happens with it'll show you what happens with the parameters you came up with in the first part of 87 and 86. Well, the crash happened in 87 in October. It'll show you what happens there. And so that's, but the thing is, just the level of volatility between what the markets were like in those days versus now is the market's probably 10 times more volatile than it was, because the levels are about 10 times higher, maybe even 20 times higher. So I think what you really want to see, it's like going walk forward analysis is like it's really like going into a time machine. And because I know that I'll explain to you when we talk about walk forward analysis how the idea actually began to emerge. But ultimately, you really want to see if you're married to the idea that you want to re-optimize every 5 years, then you want to see what actually happens if you optimize every 5 years and trade it for a year. You want to see what's going to happen. That's really what you're doing. You're saying, because one of the things we do is you'll find that all walk forwards are not made, they're not all equal. And ultimately, I believe it has to do with cycles and volatility and so forth. But you really want to know what you're really testing is whether or not your process is going to work. So if you're going to basically just you're going to optimize something for 20 years and use it for the rest of your life, you don't need to walk forward analysis, because you're just going to optimize it on 20 years of data and trade it for the next 20 years. But if you don't really believe that that's actually a good idea, and I'm one of those guys who doesn't believe it's a really good idea, then you're going to have to come up with some other kind of approach. So, for example, Dunn didn't know what walk forward analysis was when I came there. They had never heard of it, or maybe they had heard of it. They were not using it, but I explained to them what it was, and what they really wound up doing was kind of like what the people now call an anchored walk forward, which I think it's really antithetical to the idea of walk forward analysis. But they did do that. But what I'm doing, but I'm not. But in the beginning, they looked back about 10 years and they would re-optimize every year. So 10 years optimized for a year, then 11 years optimized for a year, 12 years optimized for it, and traded for a year. And that when the window sizes weren't that different, it didn't matter that much. But when you start getting to be when the optimization window went from a 10-year to a 15 or 16-year, then you're starting to get a difference there. So what you're testing really is whether or not your process will actually work, and if you're going to be adaptive, which I think is essential, and that's the one thing that I think the current markets have proven. If you don't adapt, you die. Just like any animal living in nature, you don't adapt, you die. And in trading, if you don't adapt, you lose. So really, what you're doing is seeing whether or not 1 by 3, 5 by 1, or 3 by 6, or 2 by 3 months, which one actually works the best. And that's really not something you can actually. I don't think you can actually. I've never been able to find I don't know how you can actually a priori say this is the best window, you could say this is the best one to be. This is all the work that I want to do. So I'll go 5 by 1 or something like that. You could say that and live with the consequences. But if you really want to stay on top of your game, I think it's prudent to really look at different kinds of scenarios, which is what different walk forwards really are.
The argument against anchoring the walk forward, which if I just explain it briefly, so what we're talking about with walk forward analysis is that you would take a 10-year block of data. You start in the first 2 years, build the strategy, test it for the next year, and then drop off the first year, say, from your data. Take the next 3, re-optimize and run it for the year after that. So we're what I kind of called before forgetting the earlier data, but I guess we're not.
You're not, because
it's incorporating it into it.
Yeah.
And the argument against the anchoring would be like, so if we just continuously use that first start date to optimize on, and so it'll go from being 2 years to 3 to 4 to 5. Then by the time we've got to the end, we've actually just got an optimization over the entire data set, which is equivalent to not having a walk forward at all.
Yeah, I would agree. That's why when they told me about this the first time, I thought, "What the hell are you talking about?" That's not because they put it. It's actually built into Enhanced Walk Forward Optimizer, and so anyway. But yeah, I agree. It defeats the purpose because ultimately, data back going, barring the fact that data back in the early 2000s was actually not really good data because markets were going from the pit to the electronic, and it was all kind of muddled together. Ultimately, what happened 20 years ago probably isn't all parameters that worked 20 years ago may not really work now. That's very because they're just too tight, or they're too fast, or whatever. But ultimately, you want to know that you have some way of determining the proper parameters, no matter what kind of data you're working with.
Okay, so that's cool. So that's really answering my question. So on the one hand, we want to have updated and tuned parameters to the current environment, because the markets do change. Slippage changes, commissions change, microstructure changes, exchange rules change. So we're staying up to date, but the extent to which we are also then incorporating logic in those strategies that is mindful of these big stress test events in the past is the extent to which we've run the walk forward analysis over that entire period, so that we have seen how it does perform in, let's say, in 87 crash, or a 2020 COVID crash, say. But just to drill into that one more step, but if that's the process we've gone through, let's say we do that, we run that the first time, and we get to a 2020 crash, let's say, and I'm kind of thinking end of day data here, so forgive me. Sure. Like in the intraday world, there's going to be other micro crashes, and but say we get to a 2020 market meltdown, and the strategy doesn't do so well. So we've got to make adjustments to account for that. How do we then avoid flirting with the overfitting versus like taking a logical causal approach to, I know I need to account for all of these various stress test scenarios, so it's okay to make this adjustment. How do we avoid, I guess, just sort of being arbitrary about all of those and convincing ourselves that, these are necessary adjustments and we're actually starting to curve fit all over again?
I think that ultimately, I don't think when you do a walk forward analysis, let's go back. You could, the classic, let's say the classic curve fitting scenario is where a guy optimizes a set of parameters on a market, and finds that he's got a big loss in there. That really affected his performance overall very badly. So he finds a way to actually some kind of rule or some kind of parameter to avoid that one loss. That's a good classic example of what curve fitting, overfitting really. You found, for example, that you need an adjustment, and you actually scan. You didn't scan in your walk forward, but now you scan for a bunch of different. You scan a range of targets, and you pick, and one of them really stands out great, but the other ones are all crappy. And you go with that. That's kind of a curve fitting thing. Mm-hmm. But if you're doing the same process, because in a walk forward analysis, you don't change the range, you don't change the rules, you don't change the strategy. All you do is you change the settings for a couple of the rules. You're doing this over and over and over and over and over again. So if you have 20 walk forwards in there, and you find that 15 of them are actually profitable and 5 of them are not, and especially the 5 are not, really, they're kind of spaced throughout of it. You're not really curve fitting at that point in time, because you're not really changing the rules, the parameters, or the structure. So when we look at targets, for example, we look at different targets, but we look at the full range of all the strategies in Ranger, with a small one, a medium one, and a big one. And we find that they all work, for example, but they all don't work equally well in all the same conditions. So that's when being dynamic with your choice of strategies is helpful, because you like I said, we came up with faster parameters for the NASDAQ stuff for Ranger. But we also found out that, I'm on the horn of a great dilemma here. The fast stuff is working, and the middle range stuff is working. So so what do you do? But better to have the choice of better to be choosing among 4 or 5 really good strategies than it is to have one that's really, really great, and the other 4 are all crap. You follow?
Of course, yeah. All right. Well, Bob, we've been chatting for a while, so why don't we kind of leave the audience hanging and say, look, we'll do a part 2 where we will deep dive some of this stuff and wax philosophical a little longer. But, I'll let you go for now, and, let's leave it for the next session.
Sounds good.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives. So nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky, and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.